The story of Florida real estate right now is simple and shocking. Prices are bending, costs are biting, and demand is splitting in two. Start with the scoreboard. 6 of the 10 U.S. partisan was in that exhausted in 1977. Metros, with the steepest year-over-year home value losses, are in Florida. In North Port, Bradenton, Sarasota, the median listing price sits at $478,800, with values down 8.6% year-over-year, about a $30,000 to $6,420 hit. Cape Coral's year-over-year price change is a slide of 7.1%. Naples is down 6.7%. Punta Gorda? Down 6.2%. Sebring is off 5.2%. Sebastian down 4.6%. That's not a blip. That's a reprice. Zoom in to August 2025. In Cape Coral, the typical single-family home sold for nearly 7% less than August the year before. Pull the camera back to August 2022, and the drop is over 13%. Up the coast in North Port, the typical August 2025 sales price was 20% lower than 3 years prior. These are Gulf Coast communities that ran white-hot during the pandemic. Now they're cooling fast. Yet, in the same state, South Florida signed a record. A penthouse at Lemaire Bay Harbor closed for $17,000, topping the prior Bay Harbor Island's high-water mark of $12,500. And over the past 22 months, global buyers accounted for more than half of new construction home sales in South Florida. In other words, while much of Florida is repricing, a vein of cash-rich demand is still flowing. What happened? The costs of owning in the Sunshine State climbed at the same time the air came out of pandemic pricing. Affordability cracked. The balance of fear and greed shifted. Begin with insurance. In Cape Coral, the premium-to-market ratio ranks third highest nationally at 2.2%. Put simply, a $350,000 home can carry around $7,700 a year in insurance alone. Layer in rising maintenance and homeowners association fees, and the monthly math breaks. Deals fail. In multiple Florida transactions, insurance costs alone have scuttled loan approvals after buyers were already under contract. That's not sentiment. That's a closing table brick. Add interest rates to the ledger. Higher rates are squeezing budgets across Florida. Real estate veterans say many would-be buyers can't afford the price they could in 2021 or 2022. The frenzy evaporated. People paused. The market's fever broke. Supply joined in. Builders responded to the pandemic wave by building. In Jacksonville, new construction is flooding the market with incentives on the table, rate buydowns, closing costs, making it harder for resales to compete. That pressure ripples outward. More choices for buyers, longer market times, and more sellers agreeing to cuts. Across Florida, strong inventory growth is pressing prices downward because the number of homes for sale is outpacing demand. When supply gets ahead, values give ground. Then a new force hits South Florida, a sudden chill from Canada. Canadians have long filled Broward and Palm Beach winters with bookings and bids. As of July 2025, one major oceanfront hotel in Fort Lauderdale saw Canadian visits down 32% from the prior year. The city typically sees 1.1 million Canadians annually. 2 months after trade tensions escalated between the U.S. and Canada, in April 2027, the number of Canadians flocking to South Florida's beaches began to plummet. By May, the drop reached as much as 13%. Palm Beach County usually welcomes about 370,000 Canadian tourists each year. This year, that figure was cited at 250, while some estimates simultaneously describe the decline as less than a 5% drop. The precise magnitude varies, but the direction is unmistakable. That tourism slip spilled into property. In one recent month, a single South Florida broker took 8 new Canadian-owned listings, all priced at $20,000 or more. Just a month after the trade tensions began, Palm Beach County home listings jumped to their highest level in 10 years. And by this year, 321 Palm Beach County homes with Canadian mailing addresses had sold, led by Boynton Beach, West Palm Beach, and Boca Raton. Canadians remain Florida's largest international homebuyers, making up 17% of all foreign purchases and spending well over $1 billion statewide. Their pullback is palpable. Yet even as Canadians step back, other countries are stepping in. Visits from the UK, Germany, Colombia, and Brazil are up 10%, helping fill some of the gap. And despite the turbulence, South Florida still ranked as the second and third most visited Thanksgiving destination in the country. The lights on Las Olas stayed bright. So where are we? A wave of price normalization has reached Florida. Factors stack up. Insurance in the thousands per year. Monthly payments still elevated. Maintenance rising, HOAs not budging, and a construction pipeline that increased choice. On the Gulf Coast, prices fell sharply from pandemic peaks. In South Florida, international demand kept parts of the luxury and new construction markets buoyant, even as a key northern feeder, Canada, cooled. Walk the neighborhoods and the story shifts, block by block. In Cape Coral, agents describe measured decisions, replacing bidding wars. Increased inventory is giving buyers more options. Sellers who price accurately and present well still move properties at a healthy pace. That matches the data from August 2025, down nearly 7% year over year, and down more than 13% from August 2022, but not a freeze. In the third quarter of 2022-5, foreclosure rates in Cape Coral were among the highest across major metros, a sign of stress, but also the kind of pressure that forces markets to reset quickly. North Port, Bradenton, Sarasota, where the median listing price is $478,000, $800, and year-over-year values are down 8.6%, shows the same pattern. The parts that soared in 2021 and 2022 are unwinding the fastest. In North Port itself, August 2025, pricing sat 20% below where it stood 3 years earlier. Naples is off 6.7%, Punta Gorda down 6.2%, Sebring down 5.2%, Sebastian down 4.6%. Across 6 metros, the collective direction is unmistakable. But the state's story has a countercurrent. It includes the $17,000 Bay Harbor Islands record and a construction pipeline that hasn't stopped. In West Miami-Dade County, a $1 million mixed-use community Upland Park is slated to connect directly with the Dolphin Park and Ride Transit Terminal facility. In Surfside, Surf Row residences broke ground, adding 24 bespoke condos at the beach. In suburban Palm Beach County, a 55-plus rental community was completed to meet demand for amenitized, age-targeted housing. And over a 22-month span, international buyers accounted for more than half of new construction sales across South Florida. Evidence that the global appetite for new product remains robust, even as the resale market recalibrates. On the ground, that split shows up in contracts. In some Florida deals, insurance alone has derailed financing after the buyer and seller had already inked signatures. Condo associations facing higher premiums are passing costs along. That combination has dragged condo values more than single-family in several metros. Buyers who stretched for a pandemic-era purchase are now, in certain cases, choosing price cuts over carrying costs. Cash investors, meanwhile, describe seeing more motivated sellers willing to discount to avoid cancellations and mounting expenses. It isn't that the homes are flawed, it's that the math, for many, no longer works without a give on price. None of this is to say the floor is falling away. Much of Florida remains in motion. Agents on the Gulf Coast report retirees, second home seekers, and relocation buyers still approach with confidence, just less urgency. Sellers who anchor to 2201 ask prices are sitting. Sellers who align to 2205 realities move. In Cape Coral, that means tuning to a market that cleared August 2027 at nearly 7% below the prior year, with more than a 13% gap to August 2022. In Fort Myers and Cape Coral combined, recent median listing data shows a $399,900 price tag and a 7.9% year-over-year value drop, a pairing that encapsulates the shift. Price points that are still elevated by pre-pandemic standards, but no longer climbing. The demand mechanics reshaped too. Internationally, the mix changed. Canadians, who once dominated South Florida's winter transactions, are stepping back. Among Canadian visitors who stopped coming, half kite economic changes enacted in January 2024, 46% reference disputes and tariffs, and 35% say they now harbor negative feelings toward the U.S. Overall, The hospitality sector noticed first. One, Fort Lauderdale oceanfront property, proudly self-described as a Canadian hotel, felt the absence, down 32% in Canadian visits by July 2025, with the drop starting 2 months after trade tensions escalated and accelerating by May to as much as 13%. The real estate sector is now absorbing the second-order effects. More Canadian-owned listings, including 8 at $20,000 plus in a single month, and heightened for-sale inventory countywide only a month after the dispute began. At the same time, other foreign markets filled in. Visits from the UK, Germany, Colombia, and Brazil rose 10%, and the cash pipeline to new construction towers remained international. Over 50% of such sales in South Florida went to global buyers across the past 22 months. That's the contradiction of Florida in 2005, a coastal luxury submarket breaking records while mid-sized Gulf Coast metros unwind double-digit gains. If you're a buyer, the practical reality is this: the mix of high insurance costs, persistent HOA and maintenance fees, and the return of choice gives you leverage. Across Florida, more inventory means more time to evaluate, more room to negotiate, and more sellers willing to meet today's market instead of yesterday's. In Jacksonville, new builds are offering rate buydowns and closing costs, perks you rarely saw in 2021. In Cape Coral, the buyer's advantage shows up as patient pacing, more pre-closing diligence, and the space to insist on condition, credits, or both. In North Port, where August prices sit 20% below 3 years ago, the math may finally work for those shut out during the boom. If you're a seller, the imperative is equally clear. Pricing accuracy matters. Presentation matters. The margin for error shrank as buyers regained options. In places like Cape Coral, down nearly 7% year over year in August 2025, listing at last year's comps means listing high. In Naples, same story. Values off 6.7%. In Punta Gorda, minus 6.2%. The homes that line up with current conditions still move. The homes that carry pandemic premiums sit. For investors, Florida has become a market of barbell opportunities. On one end, global capital still targets prime coastal product, the $17,000 penthouse, the 24 luxury condos in Surfside, the 55-plus complexes with built-in demand. On the other, select Gulf Coast resales at corrected prices in areas that have repriced 5 to 13% in a year or 20% over 3 years present entry points if the operating costs pencil. The key variable isn't purchase price alone. It's the total monthly carry, insurance at levels like $7,700 a year on a $350,000 home in Cape Coral, HOA dues that haven't come down, maintenance that rarely falls. Investors who ignore those inputs risk misreading yield. The question that lingers is whether this is a crash or a correction. The evidence points to a correction, and a healthy one in many respects. Observers close to the ground say the cooling shows up in prices more than in sales volume. Buyers are still out there, they're just shopping value instead of velocity. Some sellers, especially in parts of Miami, have opted to delist rather than chase the market down, which is one reason pricing is doing the work of clearing. The metaphor that fits is a rubber band snapping back, not breaking. Even the hospitality data holds nuance. South Florida still ranked as the second and third most visited Thanksgiving destination. The loss of Canadians hurt specific businesses and corridors, but increases from the UK, Germany, Colombia, and Brazil helped soften the blow. In Palm Beach County, estimates for Canadian visitation range widely, from a decline described as less than 5% to a count that fell from about 370,000 to 253,000 this year. Yet the county moved swiftly to diversify its international marketing. Markets adapt. Look ahead, and the signals suggest a base case of ongoing stabilization through 2026, with prices continuing to rebalance in the metros already identified. In Florida's Gulf Coast communities, Cape Coral, Naples, Punta Gorda, Sebring, North Port, Sebastian, that likely means more of the same: measured buyer activity, pragmatic sellers, and a market that prices in both insurance realities and the end of ultra-cheap money. Northport Bradenton Sarasota's current combination, 478,008, KB and $8.6 annual value drop illustrates how far and how fast that reset can go and how it can slow as affordability improves. Cape Coral's August 2025 numbers, nearly 7% down year over year and more than 13% below August 2022, may serve as a template for a soft landing, not a freefall. Two watch items could skew that path. First, insurance. If premiums continue rising, or if coverage availability tightens further in coastal zip codes, the affordability squeeze worsens, especially for condos and lower-priced single-family homes where the monthly payment is most sensitive. Cape Coral's 2.2% premium-to-market ratio and the $7,700 annual insurance cost on a $350,000 home are a warning. Any relief here, premium stabilization, increased competition among carriers, or targeted mitigation policies would be an upside surprise. Second, international demand. Canada's pullback sent ripples through Broward and Palm Beach. If trade tensions ease and the Canadian dollar strengthens, listings could tighten and seasonal traffic recover. If tensions persist, expect a continued shift toward other international buyers, those UK, Germany, Colombia, and Brazil gains of 10%, and more Canadian-owned inventory coming to market, like the $82,000-plus listings added in 1 month by a single broker. Beyond these, construction and incentives bear watching. In Jacksonville, builder offerings like rate buydowns and closing cost credits are a barometer for how aggressively new construction will compete with resales across the state in 2026. In West Miami-Dade County, the $1 million Upland Park project will test the durability of demand tied to transit connectivity. In Surfside, the 24-unit Surf Row build will show whether boutique luxury can sustain momentum at current price points. And in age-targeted rentals, completed communities like the 55-plus property at Avalon Trails indicate a demographic tailwind that may be more resilient than the broader resale market. Through it all, the practical playbook is straightforward. Buyers, test the math with all-in costs. Insurance, HOA, maintenance, not just mortgage rates and list price. If a home penciled in 2020.1 but fails now, ask why. If the issue is price, bid accordingly. Sellers, meet the market that exists, not the one you wish would return. In a state where 6 of 10 biggest annual value losses cluster, overpricing is a strategy for sitting. Investors, underwrite with conservative assumptions on insurance and fees, and watch submarkets like North Port and Cape Coral, where 3-year declines of 20% and 13+% from peak are already in the rear view. Florida remains a prize. The question is what you're paying to hold it. In 2025, the answer changed. Across the Gulf Coast, median listing prices like $478,800 with 8.6% annual losses, 7.1% year-over-year declines in Cape Coral, and 3-year 20% drops in North Port mark a reset. In South Florida, a $17,000 penthouse, 24 new condos at the beach, and a $1 billion mixed-use community sketch, a different arc. In Fort Lauderdale and Palm Beach County, 32% fewer Canadian hotel guests by July, and Canadian visitor drops reaching 13% by May shifted the winter cadence, while a 10% uptick from the UK, Germany, Colombia, and Brazil built a new one. In Cape Coral, an insurance ratio of 2.2% and $7,000 a year on a $350,000 home made risk costs impossible to ignore. In Jacksonville, builder incentives signaled a competitive front that will define 2026. The thread tying it all together is repricing. Not collapse, not boom. A recalibration where monthly carrying costs drive decisions, where international flows remake demand maps, where new construction forces resale discipline, and where markets that went too high too fast release air until buyers can breathe again. If that continues, Florida's base case is stability by degrees, not drama, especially as buyers and sellers grow fluent in the new math. Watch the insurance lines. Watch the passports at open houses. And watch how long builders keep paying points. Those 3 will write the next chapter. If this helped clarify what's really moving Florida real estate, share it with someone weighing a move, a listing, or a long-term bet on the Sunshine State.